The filing status of the taxpayer. This is an important process that needs to be gone through at the beginning to know what it is that the filing status is. The filing status is going to be used for threshold amounts. It's going to be used for phase-out amounts. A lot of different ways that this filing status is going to be used throughout that tax-paying process. Now, in general, the filing status is really connected to the marital status of the person. The IRS considers a person unmarried for the whole year if on the last day of the tax year they're unmarried or legally separated from a spouse under a divorce or separate maintenance decree. And as we'll see, that if the spouse dies during the year, the IRS is going to consider that surviving spouse married for the whole year and will allow that individual to file married filing jointly as if that's what they want to do. And so what we have is there are 5 filing statuses, and we'll list them here, and then we'll talk about who it is that qualifies under each of them. The 5 statuses are single, married filing jointly or together, married filing separately, head of household, and qualifying widow or qualifying widower. These are the 5 filing statuses, and everybody who files is going to be one of these statuses. So we start with single as our first one. A taxpayer is single if, on the last day of the year, he or she is unmarried or legally separated from a spouse under a final court decree and does not qualify for another status. And so in a sense, single is everybody else. Okay, if you don't qualify for one of the other statuses, you are going to be filing single. And so this is kind of what's left after you don't qualify for all of the others, you're going to be a single. But clearly, if you're not married, you're going to most likely be single, especially if you've never been married. So our second category is married filing jointly, and these are obviously taxpayers who are married. Taxpayers may choose married filing jointly as their filing status if they are married and they agree to file a joint return. Both spouses need to agree. Both spouses are responsible jointly and individually for the tax and any interest or penalty that is due. And so if you file jointly, you have that responsibility with your spouse. Now, some additional requirements about this. While different accounting methods are allowable for each of the spouses, they both must use the same accounting period and generally are required to sign the return. They can file a joint return even if one spouse has no income or deductions. And if one spouse is a non-resident alien, they must have either that non-resident alien spouse must have either a Social Security number or an individual taxpayer identification number in order to be able to file a joint return. And just for fun, if a court decree annuls a previous marriage, well, they need to amend previous tax returns as well because that marriage never really happened. Now, what we have here in terms of this married filing jointly, most likely you're going to have a better tax situation if you file jointly. But because you have that joint liability, if you don't think your spouse is reporting all of their income or you don't want to be responsible for any taxes due that your spouse may owe because they're not having enough tax withheld or they're not paying enough estimated tax, then you may not want to file jointly. So if you're married and you don't file jointly, you're probably going to be married filing separately. Married couples can choose this as their status if they want to be responsible only for their own taxes. Okay. Now, possible, unlikely that it results in a lower tax overall than filing a joint return, but that's obviously a calculation that they will need to make. But spouses generally pay more in combined taxes when they file separately than when using whatever other filing status might be available to them. So when we choose married filing separately, there are some special rules. Cannot take the credit for child and dependent care expenses in most cases. There's no earned income credit available. There's no exclusion or credit for adoption expenses in most cases. Can't take the education credits, lifetime learning or American opportunities. Can't take the deduction for student loan interest or the tuition and fees deduction. And there's no exclusion on interest earned from U.S. savings bonds when used for education expenses if we are married filing separately. Now, it's very possible that in your marriage, none of these are relevant, but if you do have some of these opportunities for tax savings, you need to be filing jointly in order to be able to take advantage of them. Now, our fourth status is head of household, and this is for unmarried individuals who provide a home for certain other persons. Now, filing head of household usually results in lower tax rates than if we were single or married filing separately. But we're looking here at unmarried individuals who are providing a home for somebody else. And there's the name, head of household. Okay? There needs to be a household, and this person is the one providing that, heading up that household. The taxpayer must be unmarried or considered to be unmarried. They are considered to be unmarried if they file a separate return and their spouse did not live in the home the last 6 months of that tax year. A qualifying person must live with the taxpayer for more than half of the year, with the exception of a parent. Now, a qualifying person generally needs to be a qualifying child or a qualifying relative for whom the taxpayer can claim as a dependent. And we'll talk about these qualifying child and qualifying relative here in just a minute. A qualifying relative needs to be a member of the taxpayer's family in order to be a qualifying person for head of household status. And the taxpayer must pay more than half of the cost of maintaining the parent's home, if it's a parent, or their cost of a facility if they're claiming the head of household based on a dependent parent. Now, in most cases, because of the residency requirement, the child of a divorced or separated parent is the qualifying child of the custodial parent, the parent with whom the child is living the greater amount of the year. Okay, whoever it is that they're living the majority of the year. The other parent is called a non-custodial parent. And so in most cases, because of the residency test, it's the custodial parent that's able to claim the head of household filing status. Now, our fifth status is qualifying widower. This is used when the taxpayer's spouse died in either of the 2 previous tax years and the taxpayer did not remarry before the end of the current year. A widow or widower is somebody whose spouse has died. So in order to qualify or file as a qualifying widower, a number of requirements. First, they must be entitled to file a joint return with their spouse for the year the spouse died. Okay, so you had to have been able to file a joint return in the year that the spouse died. Must not remarry before the end of this tax year, and must have a child or stepchild that they can claim as a dependent or could claim as a dependent unless the child had gross income of too much, the child had filed a joint return, or the taxpayer could be claimed as a dependent on someone else's return. So we're looking here essentially at a young widow or widower. We're not talking about somebody who's 80 years old and their spouse died. Well, that's unfortunate. That's not qualifying widower. You're looking at somebody whose spouse dies and they still have young children at home. Okay? They're still providing for young children. In that situation where we have a young parent whose spouse dies, they're most likely going to be able to file as a qualifying widower. So those are the 5 filing statuses. Okay, single, married filing jointly, married filing separately, head of household, and qualifying widower. We also talked about the term dependents. Now, dependents aren't as important as they used to be because there is no longer an exemption that's allowed for everybody that you're able to claim as a dependent, but there are still tax benefits that rely on the ability of the taxpayer to be able to claim a dependent. And so we still need to know who is a dependent, who qualifies as a dependent, and who doesn't qualify as a dependent. And there's a number of tests, basically, that a person needs to be able to meet in order to be able to be claimed as a dependent. So what we have here is to claim a person as a dependent, the taxpayer must meet all 3 of these tests, and we'll see there's some more as well, but these are just kind of the initial threshold test. First, there's a dependent taxpayer test. The taxpayer cannot qualify as a dependent of another person. A joint return test. Taxpayer cannot claim a married person who files a joint return as a dependent unless that married person files the return only as a claim for refund. And there's a citizenship or resident test. A dependent must be a U.S. citizen, U.S. resident alien, U.S. national, or a resident of Canada or Mexico for some part of the year. Okay? So those are the 3 kind of threshold tests that if you don't meet those requirements, well, then we're done. We don't have to go any further. But if we meet these requests, we have 2 kind of categories of dependents. We have qualifying child or qualifying relative that each have their own tests as well. So to be a qualifying child for tests, there's a relationship test. Must be the taxpayer's son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them. Okay, so a grandchild, a niece, or a nephew. Okay, that's a qualifying child, that relationship. They must be under 19 years of age or under 24 if the individual is a full-time student, or any age if permanently and totally disabled. So we're talking here about children under the age of 19 would be a qualifying child. There's a residency test. The child must live in the same principal residence as the taxpayer for more than half the year. Now, there are some exceptions related to illness or education, but they need to be living with that taxpayer who's trying to claim them as a dependent. And then the child cannot provide more than 50% of their own support. And so the taxpayer needs to be providing more than 50% of the support for this individual that they're trying to claim as a qualifying child. Now, we also have to look here at multiple support agreements. If a child can be a qualifying child of more than one person, the taxpayer that's claiming the benefits must be the person entitled to claim the child as a qualifying child. Now, in most cases, because of the residency test again, the child of divorced or separated parents is the qualifying child of the custodial parent. Now, it's possible that the non-custodial parent can claim the child for purposes of the child tax credits and credit for other dependents if the custodial parent agrees in writing. Okay, that's Form 8332. You don't need to know that, but just that's how it's done. So generally, we're looking at the custodial parent that is going to be claiming the dependent child instead of the non-custodial parent, but there can be an agreement about that. So that's a qualifying child. If you don't meet the qualifying child, you may qualify as a qualifying relative. There are 4 tests that we need to meet. First, don't meet a qualifying child. Okay, you cannot be a qualifying child of a taxpayer. The second is the support test. The taxpayer generally must provide more than 50% of the individual's support for the calendar year. But again, we have multiple support agreements. If 2 or more persons together provide more than half of the support, they can agree which one is going to claim that qualifying relative dependent. Now, the person claiming the dependent must have provided more than 10% of the total support, and no other person can pay over half of the total support. Okay? And so we're looking here at the situation where there's 5 people that provide support equally. Well, they're each providing 20%. Nobody's providing 50%, but all of those people that provided more than 10% can get together and determine who it is that's going to claim that individual as a qualifying relative. There's also a gross income test. The individual's gross income must be less than $4,300. And then there's a member of household or relationship test. This individual that we're trying to claim as a qualifying relative must either have lived in the household all the year, if they're not a lineal relative, or they must be a lineal relative. And again, there's a long list there of who is a lineal relative, but we need to know that it's either a lineal relative or they have to have lived in the household for the entire year in order to meet the requirements to be a qualifying relative. So again, we've got our 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widower. And we also have this distinction, this classification as a dependent, being either a qualifying child or a qualifying relative. And this status of dependent is important when we're looking at some of the tax credits and some of the other things that are involved, where we need to know whether or not the taxpayer has a dependent, how many dependents they have. And so we need to be familiar with those different tests in order for somebody to qualify as a qualifying child or to qualify as a qualifying relative.